Good evening, everybody. It's later in the evening. Lights are turned out. I just have the two lights to make this video. This video is reviewing PPCIAN top 10 dividend investments and dividend growth and dividend watch list. Let's begin. The first company on the list is Kraft Heinz. They're a packaged goods company. Of course, they have Kraft and of course they have Heinz. It's a fine company, I guess. I don't see much growth. I see a lot of competition. A lot of new players come in and they're pushing new generations of brands. Kraft Heinz is a conglomerate. It's going to have a hard time catching up to these companies so that it can produce continued and sustained dividends and growth. It's not really growth. You're relying on the dividends, but when it produces the dividends, it's actually dying as a business. I don't think it's going to be able to catch up and keep up with the changing world that we have right now. The second stock on the list is SJM, Smuckers. This is a better business. It's also a conglomerate, but I believe that their product lineup is more stable. More people like the products that they have. It's a more liked brand, I guess. I would go for this one more, but again, it's a conglomerate, so if it needs to catch up, if it needs to try to reach out to make sure that it's keeping up with changing market needs and changing market demands, it might not be able to do it so much because of the bureaucracy when it comes to conglomerates. There's too much paperwork, too much stuff holding it back, where a good idea might not be able to get through. Number 3 on the list is Dominion Energy. Dominion Energy is not something that I would ever go into. It's a fair-sized company. Of course, it provides its consistent good dividends. But the problem with energy is if there's a hurricane, if there's a flood, any natural disaster, an earthquake, this company might be out of commission. You don't know what kind of lawsuits there might be. You don't know what kind of downtime there might be. You don't know what kind of restructuring, reorganization. The outlook of the company will change completely, and you're not going to be able to predict or anticipate this happening. I don't want my money to be in a company where the weather is going to dictate whether I'm successful or not. Yes, it's rare, but I still don't want to have the weather be the determining factor of whether or not I'm successful. Let's just look at what's going on in California, and that's all the proof I need to stay away from all utilities. The next company on the list is PPL. It's also an energy company. It has the same issues. PPL is geographically limited. So if a natural disaster happens in that specific geographic area, you are shocked and you do lose everything that you were expecting to get from PPL. The next company on the list is Energy, EVRG. This company is also an energy company, a utility company. It's in the same boat as the first two. The reason I would take Kraft or Smuckers before the energy companies is because they can open a new warehouse, they can open a new plant, and they can be up and running. Their problems will be solved quickly. You have to invest in a lot of different energy companies to spread your liability, your risk of a natural disaster. I'd rather avoid the sector altogether than be in it and then hopefully if there's a hurricane in one place, there's no tornado or earthquake in another place. I don't want Mother Nature to be listed in the risks portion of the company if I'm going to be investing in there. The next company on the list is AbbVie. AbbVie is a pharmaceutical company. I am against any and all pharmaceutical companies because when you're looking at a pharmaceutical company, they're in it to make money off of drugs. I don't even care about the patents. I don't care about the new products in the pipeline. The issue I have with the drug companies is at the end of the day, if they don't make more money, if they don't pay dividends, if they don't grow, if they don't charge their customers, sick people, my family, me, more money, then their business fails. And I don't want to be involved in a company that's going to be in that kind of a game. I don't want the government to one day decide, hey, all medicine needs to be regulated, and all of a sudden all equity that was going to be going towards this company might stop because the price they want to pay for the medicine is too low, or the government will come in and say we'll make a generic and it'll be way cheaper. And again, you're trusting patents, and if the government itself is infringing on it, what are you going to do about that? That's not much you can do. So I'm not supporting the CEO, I'm not supporting the board, I'm not supporting the company. I'm not going to encourage them by saying you're doing a good job. I'm not going to purchase any of their stock at any value. I don't think it should be a company that's traded. I think this should be already a government-run organization. In other parts of the world, that's how it is. Why do we have stocks for people's lives? That's not something that I'm for, so I'm not going to support AbbVie at all. I don't even care about the evaluation. The next stock on the list is Prudential. Prudential is a good company. It's somewhat underhanded because it charges a lot of hidden fees to the people who buy the policies from them. It's in a lot of segments. It's not the number one in any of the segments, but it is generating a profit. It is paying out a dividend. It's okay, but if I was going to go into an insurance company, I would much rather be in Berkshire Hathaway, because I think Warren Buffett is doing much better with insurance rather than Prudential. So in terms of insurance, I'd rather be in Berkshire Hathaway rather than Prudential. It's got a more of a conglomerate, more of a safety net type of situation. The next stock is Chubb Limited. I do not invest in any companies that are not U.S. companies. If a company has laws that I need to know about, or has practices or shares situations where I might be excluded because I'm not a part of where the laws apply, that's not something that I'm interested in. It has to be a U.S. equity for me to be interested in. So I would not invest in Chubb. The next company on the list is Aflac, AFL. I have no issues with this company. It's got a limited market, a limited number of people that are interested in the product. So that's the only issue that I can see. If you're interested in buying Aflac, go for it. Just make sure you're buying it at a decent evaluation. It's not a super growth company. It's another insurance play. So go ahead and have fun. If you're looking to see if it's a good play, I would support it. I haven't looked into the prices. I'm just letting you know as a general stock how I feel about it. And I believe that should be a fine company to be invested in for the long run. People are going to need insurance. It's a steady business. There's current disruptions that are coming through. Maybe if you can think about Lemonade that's coming in, or maybe even some other companies that are only through artificial intelligence powered companies. They can probably disrupt Aflac, and I don't know how modernized Aflac is. So that's something you might have to look into. I haven't looked into that for you. This next part of the list is the top 10 growth stocks. First one on the list is J&J, Johnson & Johnson. I don't have any issues with this brand. It seems to have a stable product suite that's going to do good. It's going to raise prices a little bit ahead of inflation, and it's going to keep doing good. I only wouldn't get into it because when it does dip, I find that other companies provide better opportunities than Johnson & Johnson. They fall more and they have a bigger room to rise. So it's stable, but its stability is what I don't like. Next company on the list is Pepsi, PEP. I'm not a fan of the conglomerate. It has packaged foods, it has drinks. I don't really care much for it. It's too stable. It has no fluctuation. It doesn't have good buying opportunities. It doesn't have good selling opportunities. You're just doing a dividend play. I don't like the dividend. It's not a good enough dividend to get into it. And it's not a dividend I'm going to be looking forward to. I don't care how much it grows the dividend. If I were to buy a growth stock, I would be much better off than staying with a dividend. I would prefer to be in a stock that fluctuates more than 20%, and I can buy at the bottom, sell at the top, buy at the bottom, sell at the top, buy at the bottom, sell at the top. Just keep going, cycling through, and I don't mind the volatility. So Pepsi is too boring of a business for me. I would not get into Pepsi. Next stock on the list is McDonald's. I am a fan of McDonald's. It's a good company. It does seem to be growing at a reasonable pace, and you should be able to do good with that one. It has a good dividend too. I am in full support of McDonald's. The company, no matter how many people come out and how many times they try to bash it by saying bad things about it, people love their McDonald's. People are going to continue to go to McDonald's, and McDonald's is not going to shy away from any challenge to change its image, to adjust, and to attract the customers that it has, and to keep being a number one player, top brand. Next company on the list is UTX. UTX owns Otis Elevators. It's over 80% non-US owned. It's not easily tradable in the platforms that I have, and because it's not a US company, I'm not interested in participating. I only want to be in US equities where I know my voice can be heard, my vote counts, operations of the company, and I get a say in how the company's run. Next company on the list is Clorox. It's a good brand. It's really hot right now. I would let it cool down a little bit before I got in. It's a good play along with Johnson & Johnson. I have no issues with Clorox. It's a good stock. Its growth isn't amazing. The dividend isn't amazing, but nobody is about to outdo Clorox. They are not going to be easily moved from that throne. Next company on the list is DUK, Duke Energy. PPCIAN has also stated that this is his preferred energy company, and it's also difficult to get. I agree. And also, you already know how I feel about energy companies and their businesses. I don't want a geographically limited company. I don't care if it's regulated utility. I don't care if everybody has to pay. I don't care how it raises its rates. I don't care about any of that. If there's a hurricane, if there's a flood, if there's a tornado, you don't know the extent of the damage. You don't know how much it's going to cost to fix it. You don't know if the dividends will be interrupted. You don't know how long it'll be interrupted. You don't know how the company will be emerged. You don't know if the state will sue them. You don't know if the state will help them get back on their feet. In any case, I don't want to be involved in an energy company at all. It's similar to the health industry. I don't see that being a good net play, even if it has dividends. Next company on the list is O Realty Income. I have no issues with this company. It is in some places where it has commercial loans and commercial real estate. It has commercial real estate, and I'm not in favor of any company that's in commercial real estate. I prefer REITs that are mortgage REITs, or I prefer residential REITs, not commercial REITs. That's not something that I'm interested in. Next company on the list is Procter & Gamble. I'm happy with this company. It's got a good set of brands. Go ahead and get into the Procter & Gamble. I'll give you my overall roundup of what I think you should do when you're picking these stocks to put in your group. But let's get to the end of the video before I give you that breakdown. Next company on the list is Coca-Cola, KO. What I would really like to see from Coca-Cola and Pepsi is maybe they steal some market share from their biggest competitor. I want to see Coca-Cola all of a sudden show up at KFC, Pizza Hut. It's not going to happen. Taco Bell. I want to see all of a sudden Pepsi show up at McDonald's. Pepsi show up at Burger King, Carl's Jr., Jack in the Box. That's not going to happen either. If I'm not seeing any moves, they're not interesting me. They're stable. They're gonna grow. They're gonna increase the prices a little bit, and they're gonna give you the dividend. That's fine, but it's not a company that I'm interested in. I'm not close to retirement. I'm not looking into these companies at all. They're not something that I would be interested in, short term, long term, anything. I'm not in a part of my investing career where I would be interested in buying these companies. They're too stable. They're too fixed. I'm hoping for something that's going to return more, give me more opportunities, allow me to grow. I don't mind the volatility. I don't mind the risk. I want volatility and risk. The last company on this list is 3M. 3M is a great company. I have no issues with 3M. The only thing I have to tell you is that it is more in tune with global trends. And when global trends are in tune, you're kind of on the whim of what the global economy does. You're also facing what currencies are doing. across the world, because if 3M has to ship products, if it has to deal with tariffs and global slowdowns, global production, all of these things are very global, and I don't necessarily see that as an advantage. It's too big for it to be focused to deliver the type of growth that I'm really looking for. So I'm fine with 3M, but it's not going to be a number one player. So let's round up and get to what I would do with the companies that I actually like from IPCIAN's list. I would like to buy these companies, but if I buy these companies in a $10,000 portfolio, I would make them at most a 20% of that portfolio. The rest of my portfolio would be growth stocks. My number one and my number two position would have to be growth. My number three position is going to be something that I love, my favorite stock. The dividend is kind of going to be in the back seat, just taking it easy, giving me my consistent dividends, but it's not going to be reinvested. Whatever dividends I get paid out will be put towards growth stock. It's going to be going towards my cash pool to grow my cash pool so I can grow my growth section. That's how I would handle the dividends from these dividend plays.